So today we're going to talk about some big updates. Today we got some pretty big news. We got an inflation report, the third in a row, that is showing inflation surprising to the upside in the United States, higher than expected. So we got 0.4% month over month increase, which is substantial. That's a 4.8% annualized read. It is definitely a surprise, but the biggest piece is that this is falling in line with the bad January report, which was, again, 0.4 month over month increase, which is showing a 4.8% annualized, February showing a 4.8% annualized, and now March showing a 4.8% annualized. If you remove the outliers, which is really, really low inflation we had in the fall of 2023, which rallied markets saying, hey, rates are coming down, inflation's beat. Not so soon, not so fast. Looks like inflation is not beat. Looks like we might be coming back up again, 4.8% with a 4 handle on the annual read, potentially towards the end of this year, given the last 3 reports we've had. It would be interesting to see into the summer with the current geopolitical struggles, oil nearing all-time highs and the price of gas at very, very high levels. I think we're going to have some new challenges ahead and some headwinds to lowering rates. That's in the US. So in the US, they got a strong economy, apparently. It's mostly in the strong jobs report. Again, apparently, government-funded jobs for the most part. So government deficit spending causing a strong economy. When you look at the small and middle business and private sector, it's actually not doing very well. It's just tech and government that's doing well. So it's a very interesting economy where many are suffering, many are struggling. The bottom half really struggling right now. Inflation being extremely persistent. Rates are going to be playing out higher for longer. You heard it here in 2022. You heard it here in 2023. You're hearing it now in real time. Rates may need to be more, I don't know if rates need to go higher, but they need to be, I think policy needs to be more restrictive. I think it's better, for the overall long term of the market for things to be a little bit more restrictive. So that's what happened. As the Fed, I think, is sort of backing away from their lowering rates. I think they're like, let's just wait and see. And the longer they're waiting and seeing, they're thankful that they did, because we've just now had some resurgence in inflation. Inflation's surprising, running about 25 to 30% higher than they were initially expecting and plotting. So seems like their estimates are off as per usual. Remember, inflation was transitory in 2021. So they have a really terrible track record for the Fed predicting how things will go. So we take their estimates with a grain of salt, and we see exactly what will happen. We plan for the worst and we hope for the best. In Canada today, we had a rate hold. So interesting, you switch to the Canadian side, what's happening in Canada? Well, our core inflation is like 7% for housing. Our grocery inflation is actually much worse than the US. And on top of that, the Canadian economy is not strong. We are nearing contraction, lack of growth. GDP is not strong. Again, Canadian GDP is tied strongly to real estate. And because real estate is not doing well, and the fact that in Canada, we have 1 to 5 year fixed rate mortgages, and half of Canadians are on variable rate products. More than half actually now are on variable rate products, or products with less than 2 years left in their term. Whereas in the United States, the average house either is paid off or has a 30-year fixed rate mortgage. Majority of mortgages are 30-year fixed rate in length, which means that they're locked in at 3-4% for another 20 years potentially, and don't feel the effects of this in the same way as we do in Canada. So a big difference to the way that our markets operate, and why the Canadian real estate market took such a nosedive in ways that the US market did not. So I think substantial differences between our two economies. Again, because the global trade that exists between our two countries, Canada and the US are sort of linked together just like this. In Canada, though they may need to lower rates, because again, Canada is suffering in a way that the US isn't, we can't because of global trade issues with our currency. If we were to drop rates before the US, then capital will flee to their treasury bills, and our currency will lose some value there. So if you think through that, there's some ramifications. I think that's really interesting. We look back at how that affects our portfolios, how that affects our real estate portfolios as well, our stock portfolios, all of our different asset classes. I think that it's holding anything that's inflation hedged is smart right now. I think inflation is on a bit of a runway train, and they're running out of room for keeping it under control. So I think it's really smart. The government has showed us, I think the Fed has really set the example for the world, that they're comfortable and okay with higher than 2% benchmark inflation. They may even settle with a number in the 3 handle, which is again 50% higher inflation rate than the target 2%. And over I think the 5-year span from 2021 to 2026, I think we'll see a 200 to 300% higher inflation than the 2% benchmark they initially were aiming for. And if you look at core inflation, even worse. So what does that mean? It means that the power of your dollar in 2020 to today has lost about 25 to 30%. That's the actual data right now when it comes to buying groceries, it comes to buying rent, housing, pretty much everything. Certain sectors obviously more negatively affected than others. You have to look at the basket of goods to determine which ones make the most sense. But how does this play out for you? Well, it means that if you didn't buy, gold, real estate, you buy things like stocks that are inflation hedged and will move with the devaluation of the currency. Because overall, the government is trying to devalue their currency at a rate of 2 to 3% a year for inflation. And it's actually been devaluing at 6% for the last couple of years, compounded, meaning that the value of a dollar goes down drastically over time. So if you're holding dollars under your pillow or in your bank account, don't do that. That's not well advised. That is the worst possible thing you can do in this market. No, probably not the worst. The worst would be taking on risk and betting against the market when it moves up, like I did when I was hedging against a stock market correction in 2023. But in hindsight, the advice that I have for you guys is obviously don't short, and obviously don't hold on to cash. You've got to put your assets at work. You've got to use leverage and debt against strong cash flowing assets to allow your portfolio and your net worth to grow over time. So anyway, if you guys notice, the episode's gonna be a little bit different this week, a little bit shorter. I'm gonna try to do a little bit of Q&A at the end, but I wanna make the episodes shorter, more pithy, more substance, more of a weekly update. So I'm gonna share with you what's going on in my life, what are some cool things that I'm tackling. We've got a lot of really great projects on the go right now between Florida and Ontario. There's a lot of things, going on, a lot of expansion. We're trying to build out a really nice foundation so that I can, in the future, acquire several hundred units. I'm going to build a nice real estate portfolio for myself. I think that's just the way that I want to be exposing myself to risk that I can manage. In the stock market, it's very difficult to manage risk. I can read reports, I can understand what's going on in the market fundamentals, and I can invest, kind of against that data, but I don't have an edge. In the real estate world, I can negotiate really great edges, really great what's called a competitive advantage, or alpha, where I can get alpha, where I can go in and buy your neighbor's house for 80 cents on the dollar, 75 cents on the dollar. I can go into a motel that's struggling and say, hey, I'll take this property over. We just acquired one where we walked in with $100,000 down, took over both motels, and they seller financed it at 3% and 5% mortgages. So those are great deals where I can get in there with low capital, high leverage, great cash flow. The debt is very manageable. That's what you want. You want an asset that produces a lot more income than the cost of the debt against that asset. You want a nice healthy spread there. So if things do go bad, if rates do go higher for longer, you're protected and your asset is still cash flow positive. And then as they let the inflation meter run, as they let the prices of things rise, over time what you get is a really nice and healthy, what I would call a nice appreciation boom, led, I think, in large by inflation. Now, there are other, I guess, bullish factors for things like real estate. For instance, I think that it's really key to look at the cost of materials rising. I think there's a limited supply of things like lumber, even construction labor. Laborers have been getting, their wages are moving faster than inflation, which is a good thing for the economy overall. Not so much in Ontario. In Ontario, trades labor is struggling right now. They're seeing a lot of unemployment in that sector. Again, it's mostly private sector is the problem that funds that, and real estate's in the toilet here in Ontario and in Canada. Driven largely by the high rates. As rates fall, and again, the government's afraid to lower rates because they know that real estate will just rip up if they do. So they're very cautious about lowering rates, and they said that today. The Bank of Canada's meeting today when they held rates, they left the door open. They said, we know that Canadians want rates to lower. That was basically the verbiage they're using. We know that everyone's struggling. We know that the bottom half of Canadians who are on fixed income are really struggling because inflation's running out of control. So we either screw the top half or screw the bottom half, and we have to choose between the rock and the hard place, unfortunately, in Canada, because our economy is not as robust and strong. So that was sort of the challenge. It was definitely something that I think was a bit of a surprise for some, not so much of a surprise for me. I kind of was expecting the higher for longer narrative. I do think towards Labor Day, we start to see our first rate cut. We've got to be very careful about how we cut rates. We don't want things to get too crazy, too hot in the real estate market. That will undo most of the pain, because remember, high inflation is the most pain you can give to a population. It is the most painful blow you can deal to people, because when inflation rises faster and the purchasing power of your dollar that you're earning every day from your income is depreciating so quickly, you get chaos, and it's hard to do business. Like, let's say I'm working on a project as a business owner for another business owner, and I price it out a year from now. How do I do that when I don't know what prices are going to be, when prices aren't stable? So we need to keep inflation expectations anchored, and we need to keep our economy strong at the same time. So it's kind of like the rock and the hard place, and they're sort of trying to play the levers. I wouldn't want to be in their position. Definitely a tough tough situation to be in. Let me go to the Q&A real quick, and then I'll go back to what's happening in the real estate market. We're into the spring. I'll quickly just give that before we're at the 10-minute mark. So I wanted to do really quick before I do the Q&A at the end. I will give you the real estate market update. So we're going into the spring market. Spring is typically the hottest time in real estate. Properties look their best. The most listings pop onto the market. It is the time when most properties transact. So most of the deals that are going to happen between now and June. People want to buy now. They want to close in the summer. They want to move in and be comfortable before the start of the school year, before the winter comes. No one wants to move in the winter. No one wants to deal with that around the holidays. So this is the time when most houses transact. You'll see the most amount of volume of everything going on. And because of that, typically you'll get what is called a spring boom. Every year, seasonally speaking, from around December being the low point to May, end of May, May 2-4 being the high point, sometimes into June, depending on the year, depending on the weather, you'll get a 10% price. If assuming all of the things are equal, you get a 10% difference in the price of housing. So $1 million house will sell for $900,000 in December. It will sell for $1 million in the spring. That's a decent amount of difference. 10% is a lot. We get that seasonality every year here in Ontario. We're going into that period. So we're on the back of that seasonality with the hope that rates are going to fall into this fall. There's been a lot of cash on the sidelines, a lot of investors waiting, a lot of home buyers that have just been like waiting to see what happens. I think a lot of the signaling from the Fed that, hey, rates are going to come down soon, not yet. We're sorry, we promised 2024. It's going to be probably towards the end of 2024, fingers crossed. But I think a lot of that language, that signaling is bullish, I think, for real estate prices. The US Fed, Jerome, has been very clear that his 2% hard target is no longer a hard target. It's a moving target. We'll get there eventually, close to 2, maybe 3. What that says is that the Fed actually is okay with inflation being much higher than they originally said, which means, again, I think that's a bullish signal for us to pull into real estate as an asset class or other asset classes that are inflation hedged. So businesses, too, you can buy stock in businesses that are inflation hedged. One, I guess, warning if you're getting into things right now, just know that you don't want to go all in. You don't want to use leverage and put on a lot of risk, because during these times when we're in an inverted yield curve, and right now where the 2-year, 10-year bond is inverted, so that it's a bit of a risk. The last time it was inverted, it's actually longer now inverted than it was in the late 70s and early 80s. So it's the longest point in history that the yield curve has been inverted, that the returns are higher in the short term than in the long term. That's very weird. Usually the longer you lock your capital up, the better your return should be. It's very counterintuitive that you lock it up for longer and you get a lower return. Why would you want to lock your money up for longer for less? It's just very silly. So the inverted yield curve, it typically is indicative of and followed by a recession or an economic pullback. There has never been a point in history where we've gone through this inverted yield curve and not followed by a recession. So it would be a first if we didn't have a recession following this inverted yield curve. It'd be breaking history. So just remember that there is potentially a lot of turbulence. However, we're in this new AI boom, driving revenue to new levels, new efficiency, being able to fire a lot of staff to increase the bottom line. That's a new world. We're like it's almost like the .com or the Industrial Revolution, but driven by computing AI power to do things that humans can at much more efficient routes. So anyway, that's what I have for today. That's the quick show. That's the weekly update, but I'm going to go to the Q&A. Dominic says, love what you do. My question, how do you find this information and news with real estate stocks, etc.? Thank you. So really just following different stock news sites. I'll see it pop up on my feed. I subscribe to a few email letters as well. Just Googling too. Like I have it on my calendar when, like this morning at 8:30 in the morning, Eastern Standard Time is when we got the inflation data. So I was obviously up at 8:30 this morning just to read that report, see what things were saying. It was interesting to see the annual on insurance, auto insurance being 22%. I don't have any of that data in front of me. I want to also set up a computer in front of me here and get my laptop down here and start giving you guys more quality data as opposed to what's in my brain. I'd like to, instead of just brain dumping, actually provide some quality stuff from the internet, Someday we'll have a chip in our brain. I'll be able to access all of that for you guys in real time and process it for you, but we're not there yet. David says, hello again from Alberta. Hey, David, how you doing? Randy says, I have a condo with break-even cash flow. If I sell it, I get $150,000 net. I can't buy a cash flowing property at $150,000 in my local market, so I'd be trading one neutral for another. Interesting. So you got some challenges there. There may be tax complications selling that property. Maybe there's a way you could change the property to Airbnb or to rent it by the room, do a furnished rental, simply about buying some furniture and then renting it out as a furnished luxury executive corporate stay. For a 1-year lease, you could get more money because you're providing furniture. There's lots of cool things you can do to increase your cash flow. Just throwing some ideas out there. I'm sure you'll think of something. The challenge is, I guess, what do you do with 150 grand? Well, 150 grand could be lent out against other real estate projects in first secured position with a safe loan to value against the project. So you're not taking a lot of risk, less risk than if you're what your capital is doing right now in the property. Because again, right now you're the last bit of risk. There's a mortgage probably secured, and then your equity comes in at the last. So if the property drops 20% in value and you put 20% down, you can lose 100% of your investment before the mortgage holder loses their first dollar. Because again, they're secured and your equity takes a risk before the first dollar of the mortgage is affected. So mortgage lending can be a safer way to get a great return, especially in this market where the bond market's so interesting right now, where you can get 6, 7, 8, 9% interest risk-free. We're looking at a 9% yield risk-free. If we were in the 2% market we were in 3 years ago, we'd be having a totally different conversation. But I actually think you can get better debt level returns with way lower risk than on the equity side, especially because given the inverted yield curve and given the economic instability and the geopolitical instability in the world right now, I think there's a lot of risk in equities. Equities are overbought. They're near all-time highs. Could they go higher? Very much so. Could happen. There's a lot of downside risk though. So I think that taking capital and finding certain bond products or mortgage products that make sense in this market where you can set up risk-free return, great place to be right now. So that's my advice. Chinook says, based on your experience, property prices, cost of material construction, landlord-tenant laws, U.S. market seems to be more attractive. So I'll give you my fair shake on, I'll give you a 2-minute synopsis on my fair shake, an assessment on Florida, the United States, and Ontario, Canada. The differences, what I like better about each place. I don't know that the U.S. is necessarily entirely better. In some ways, the motel laws are the same if you're talking about motel type real estate or short-term rental or Airbnb. In some markets in Ontario where it's allowed, it's better in Ontario than it is in Florida. Financing terms are better in Ontario. Specifically for large multifamily in Canada, there is the CMHC, Canadian Mortgage Housing Corporation, that will lend 95% loan to value at prime minus 2% for large commercial products. That's really interesting because in the US, you don't get that kind of financing in the same way. You can't put 5% down in the same way. There are SBA loans in the US they're basically for small business loans. They go up to about 5 million, I believe, in size. They are floating at 8, 9% interest. So you can get 30 and 40% cheaper interest-only payments in Canada. So Canada has much better financing, much better terms in terms of what you can do with lending. So there's some specific advantages, I think, to investing in Canada. And I know there's a lot of negative things about Canada and Ontario specifically, but Canada has a lot of really great things going for it that the US doesn't have. In terms of the court system, landlord-tenant board is much worse in Ontario. I'm going through some evictions in Florida. It takes 2-3 months to get a bum out that doesn't pay. So there is still, it's not perfect. There is still a challenge to getting out people who try to steal from you and steal housing from you. In Canada, it takes longer for sure. In both cases, I think that the cash for keys method is preferred to going through the court system. It is my experience that the court system fails us both in the US and in Canada. I've dealt with it failing us on both accounts. So that'll be my thought on that. Is one more than attractive than the other? Again, it depends. You got to remember that in the US, you've got 38% of a currency rip between the Canadian dollar and the US dollar. So if a project is 100,000 here and it's 138,000 there, even if it's 100,000 USD priced, you have to think of it as 138,000 to equalize the two. So there is a challenge there with the currency difference. If the dollar was at par and US and Canadian dollar was at par, I'd be loading into US projects. But some of the currency differences right now, being 136, 137, adds some complexity, I think, to cross-border investment. There's also tax complications that are interesting and difficult to maneuver. They can be dealt with, but they are around double taxation and around how do you structure things. In terms of like getting credit can be more of a challenge as a Canadian going into the US. We're able to maneuver those things and there are levers we can play with. And I do like the US market, but there are challenges too. The Airbnb tax, as an example, in Florida is like almost 12%, very much the same as HST that we have here in Ontario. So there are, and the licensing programs there are complicated. You have to fill out monthly reports to declare to the federal government every dollar that you make from Airbnb and then pay a tax on that, both municipally, statewide and federally. There's separate reports you have to fill out. So you don't have to do that in Ontario at all. You don't, once a year, you just disclose what you made. So there's more corporate reporting and more reporting in general that I've noticed in Florida, and there's licenses you have to get just to run a simple Airbnb property that you own. So there's some unique nuances investing in, say, Florida in the United States versus Canada. And there's pros and cons to both. I think that diversifying your portfolio is a smart thing. If you want to be spending your winters down there and building a portfolio where you want to be, makes the most sense. The geographical advantages to checking in on your portfolio and living where you have your properties, I think is significant and it makes a difference. I've noticed a difference when I walk the streets of the places that I invest in. I'm a better investor for it. And when I talk to the locals and I understand the culture and I understand the market in a way that you can't see on paper, when you go and experience that place, those advantages are, I think, understated sometimes by some investors who talk about remote investing. Just something I'm going to say, and I'll leave that out there. Both are great. There's definitely pros and cons to both. And I think that, being all in on one location can be dangerous. So remember, diversification is important. Never put all your eggs in one basket or all your assets in one place. Grinder says, hope all is well. Does a soft landing seem impossible given what's going on? No, I think that a soft landing is possible. To kind of answer your question on the economy and where we stand, I do think that it's very likely that we land this plane between the rock and the hard place. But the question is, where do we fall? How long does this take? Because there is damage to letting inflation run for 5 years at elevated levels. So what does that do to the middle class and to the bottom 30% of people who are on fixed incomes? I mean, they're destroyed. The US dollar has lost 25% of its buying power in the last 4 years. 1/4 of the entire value of the US dollar is gone. If you map it against the money supply, it's pretty easy to predict. The more dollars they print, the lower the dollar value is. And that's just, it actually does make a lot of sense. And we saw this coming in 2020, 2021. These are the sort of the base effects of printing a whole bunch of money, increasing the money supply. Now they're tightening, and we should get economic contraction, but we're in the middle of an AI boom. So it's interesting because usually when rates rise like this, it's difficult for equities because there's so great return in the debt markets, in bonds and whatnot, and treasury bills, that it's hard for equities typically to raise capital. But the markets are roaring to all-time new highs because the market believes that rates are going to fall, and they also believe simultaneously somehow that inflation is beat. And then I've heard, like, no matter what, whether inflation is high, equity's up. Inflation is low, equity's up. Rates go high, equity's up. Rates go down, equity's up. It's like, for some reason, every case is a bull case. And I don't know, I've talked to a lot of bullish investors, and the world just seems very, very bullish right now. So very interesting that, the every reaction, whether good or bad, seems to be good for the stock market. But my overall, I guess, thought is that I didn't expect it to be this easy to raise capital in the stock market right now. These AI projects are having a really easy time raising capital. And that has accelerated how fast companies like NVIDIA can grow when their stock does 500% rips up. When MicroStrategy stock, rips 500% up, that actually causes them to buy more Bitcoin and push the price of Bitcoin up too, and makes it easier to raise capital for, NVIDIA to expand their AI chipsets, right? To new and better technology that allows us to do more. On the other side of that AI, there's tons of cons, right? Like, from energy consumption perspective, it costs like 10 times the power to run one AI chat GPT search that it does to a Google search. So it's going to use like more power than the entire United States has right now to run these. So that's another challenge. Like, there's the whole environment shit, and like people are worried about the environment, but it's like we have an AI boom that's going to basically create some global warming, a lot of emissions to fuel all of this. So I don't know how this is going to play out. It's interesting to see, and I'll keep you guys updated every week with how things go. Trying to keep these 25 minutes was my goal for this first one. So I got 2 minutes left. Trying to keep it active and fast and energetic, and a weekly update where we all tune in. You can share it with your friends. It's quick and easy. And okay, so is it time to buy a GIC? Potentially. I mean, you can get 6% type yields. I think there are better products you can get. Like, you could do first mortgage lending, say 60% loan to value on quality real estate in Ontario with a 10% yield. So I think you can get the same level of return as a GIC, but a 10% yield just by looking in the private mortgage realm. But don't take a lot of risk. Make sure you really vet the property and you really vet the borrower. Okay, next one was double-digit rates, oil triple digits, gold all-time high, silver will follow. The currency war is here, and the yen just hit 1990 levels. Here we go. That is an interesting take. The yen definitely has hit some interesting levels. We're starting to see some really interesting things, I think, in terms of the different currencies and how that could play out. We may be in a currency war coming up. That's very possible. Gold and silver are rallying right now. A lot of the inflation hedges are rallying. Real estate is only depressed due to how high rates are. But if rates start to fall, I mean, that could be really interesting for real estate too. In the long term, I'm really bullish. Stella says, could you name companies that have safe returns and mortgages? So the biggest thing to do is go call some mortgage brokers. Do some due diligence on the property. The most important thing is look at the appraisal on the property. If a property is worth $500,000, don't lend more than $350,000 on it. Make sure the borrower has an excellent credit score. Go and check their tax returns. Go and check their bank statements. See how they're spending their money. If they don't want to share that stuff with you, that's too risky. Any good qualified borrower has no problem sharing that information. When I'm borrowing, I my lenders, I let them know. I say, here's my tax returns, here's my bank statements. You can see my assets. I don't need your money. That's the best time. That's the best type of borrower, is one who doesn't need your money. So look for that kind of person who's looking to use your money to invest, typically, and has a really great track record. But more importantly, they're a strong financial background right now. Not a year ago. What are they doing right now? What is their credit score? What is their assets? All that. Do that due diligence, and it will pay off in a great way. You can get probably a 12% yield right now in some of the mortgage products. I would say 60% loan to value, which is near zero risk. The market has to fall 40% from where it is now. It won't happen in real estate. But if it did, I mean, the whole world would be collapsing. The banks would be collapsing. It won't happen. So I would call a risk-free return. All right, I got to pick one more question. If it's $20,000, Nathaniel, I think it doesn't really matter what you invest in. Just spread it around. Buy the market. $20,000. If you get a 8% yield or a 10% yield, you beat the market by 20%. Maybe you get 11%, 12% yield. Best case scenario. We're talking about a difference of like $200-300 a year. So right now, the most important thing is to find ways to earn more money. Increase your skills, pick up a side hustle, earn more money, and then spend very little. And try to save all that and throw it into your investment account. As that account builds, it becomes really important what you invest in. But if you're just getting started, it doesn't really matter what you're investing in. Buy the S&P 500, buy an ETF that buys a little piece of the world index, buy the VTI world index, a little piece of everything. Maybe do a little bit of mortgage lending. There's some REITs you could buy right now too. Look for value, spread it around, don't put it all in one place. But most important right now, if you're just getting started and all you have is $20,000, the most important thing I would say is to just find ways to earn more money and to reduce those expenses. I've been saying it for 7.5 years. I've been screaming it 8 years from the rooftops. My catchphrase and my slogan, which is spend less than you earn. Spend less money. Find ways to spend less. Find ways to earn more money. Pick up a side hustle. Pick up a second job. Increase your skills. Get a raise. Find ways to provide value for the world, and you will get value back. And third, the difference between that. What you're earning, what you're spending, there needs to be a big gap there. You should be earning a lot more than you're spending. If it's close, it's because you're spending too much or you're not earning enough, or both. In most cases, people spend too much. So find ways to spend less money, find ways to earn more money, but have a nice healthy gap, start investing it. That invested capital will help you to earn more money. So the ceiling just grows. As your investment pool grows, you will have the life that you want to live. You can buy yourself freedom from having to work for the rest of your life, financial freedom. That's what this channel was made to teach. It's what I'm trying to do every week. So these Wednesday shows are going to be about teaching you to find financial freedom. We're going to talk about real estate, stocks, market updates, how you find your way through investing and earning more money. So thank you everyone for tuning in tonight. I really appreciate it. I'm trying to bring up the energy. I'm trying to revive the show in a way that it didn't have before. So if you got some value tonight, smash that like button, jump in the comments if you're watching the replay and say, hey, Mike, I really enjoyed tonight's show, and share it. Share it on your Instagram. Tag me, please. Share it on your Facebook. Tag me there. I'd appreciate it. And if you have ideas for future shows, please leave them in the comments or send me a private message. As always, thank you for tuning in. Spend less, earn more, maximize returns, the difference. See you guys next week.